Okay, hi there. We left off yesterday with consumption externalities. So we have a look at production externalities today. So remember, this is all to do with market failure. We said that market failure is a situation in which the free market, so no government involved, misallocates resources. So it produces too many of some goods and too few of others. And we said that externalities are a side effect on a third party. So production externalities then, what they're to do with then is they are side effects of manufacture. So it's not when the product is used that the problem comes about, it's when it's made. Now, in theory, there are positive and negative externalities of production, but the only ones that you need to know about are negative side effects. So all we're saying is that there is an impact on a third party as a result of a product or service, a good or service being made, that is ignored by the consumer and the producer. So it's the same definition as yesterday, just that idea that we're not taking all of the costs into account. So what we're saying is that the true cost, the marginal social cost, that's the full cost of all the facts of production that are used, whether they're used by the firm, the marginal private cost, that's the supply cost, so that's the cost that the firm actually pays, or whether they're impacts on third parties that also use up factors of production. So the external cost, the negative impact on third parties. So for example, it's the cleanup costs of global warming, dead polar bears, that type of stuff. And what we're saying is that the full cost, the true cost, is made up of the cost that's actually paid, the paid cost by the firm, plus the impact on third parties. But obviously the firm doesn't care about that. It only takes into account its private costs, and therefore supply is going to be too high. So if we look at how we would show that, so why is there a market failure? We say, well, look, that's costs and benefits, price, that type of stuff. There's output. Here's supply, which is based on the marginal private cost. It's just marginal cost. Same thing. There's demand, which is marginal private benefit. And we're going to assume there are no side effects from using the good. So we're going to say that the marginal private benefit and the marginal social benefit are the same. So there's no consumption externality. And that means that the market equilibrium will be there as EQ. But the problem is that the true cost is higher than the cost that the firm is actually paying. So the cost to society is all of the cost the firm pays because the firm uses up land, labour, capital and so on to make this stuff and scarce resources. But there is also an additional cost. So there is that cost there per unit, that's paid by the polar bears or by third parties or so on and so forth. And therefore the true cost is up here, the marginal private cost plus the external cost. And the problem is therefore that the socially optimum level of production is there, where marginal social benefit equals marginal social cost. If we'd stopped there, then we would have had community surplus of that amount. But we didn't. Because firms don't care about the external costs, they oversupply. They supply too much, and the equilibrium, the free market equilibrium, is to the right of the socially optimal level. And for these units here, these all create problems. And the reason they create problems is that the social cost is greater than the social benefit. You'll note I'm not saying that the social cost is greater than the private cost, because that's true for all of these units. But what we're saying is the ones that really matter are these ones, where the extra social cost is greater than the social benefit. And that kind of creates anti-welfare. It creates a welfare loss of that orange triangle. So then what can we do about any of these things? When we have negative externalities, whether they're production or consumption externalities, it doesn't matter too much. One obvious solution is that we could use an indirect tax. Now, indirect taxes come in two types. There's what's called a specific tax, and that one is simply a certain amount of money per unit, e.g. £10 per unit. Or it can be what's called ad valorem, which is a percentage tax, based on value. The only difference is the way in which they affect the supply curve. And the point about indirect taxes, and this is what everybody gets wrong, is that they impact the firm. It is the firm that pays the cost. And we looked at this elsewhere. Yeah, it's not you directly that pays the cost to the government. So in the case of, that says supply equals marginal cost. In the case of a £10 tax, all it does is it increases the firm's marginal cost by £10. So we get a parallel shift. A percentage tax increases it by the percentage of the selling price. So suppose we had a 50% tax. If the selling price was £10, the tax would be 5. If the selling price was £20, the tax would be 10. If the selling price was £30, the tax would be 15. Therefore, the firm's cost shifts out in a non-parallel fashion. It pivots. Okay, but it doesn't matter which one you use, as long as you use the one that the question asks. Yeah, but in terms of your own use, if you're freely introducing a tax, it doesn't really matter which one you use as long as it matches what you say. But if we look at the effect, then we can say that the impact is going to very much depend on elasticity. But let's look at a standard situation first of all, and just suppose that price is 20 quid. And what we decide to do is we decide to impose a £10 tax because we're trying to internalise an externality. So let's suppose so supply shifts to ST. That's then your £10 tax. So what we're going to analyse is, well, what's happened to the equilibrium? What we can say is, let's suppose that was 100 units. It's pretty obvious that demand has fallen to about 80 units. You'll note that demand hasn't shifted because it's a change in price, so therefore it's a movement along. Yeah, so demand has fallen in that way. But the big question is, what is this price here? And everybody's tempted to put £30, but it isn't. Yeah, and you can see that because we know that there is 10 quid. The firm hasn't managed to pass the full amount on to the consumer, presumably because it faces competition and so on. What we can see is if that whole distance there is 10 quid, and if that was £20 originally, it's gone up by about 7/10 of that. So that's £27. So the firm has managed, when faced with a tax of £10, the firm has managed to increase the price to consumers by £7. But nevertheless, the government will still say, well, look, I want my £10. So the firm charges 27 quid to the consumer, then has to pay £10 to the government, which means that the firm only ends up receiving £17. So this tax, the total tax is £10 there, times the number of units there. So the total tax is the whole of that red box. Effectively, the way consumers see this is they say, well, look, from my point of view, price has gone up by £7. I see myself as paying 7 times 80. Yeah, so the consumer sees themselves as paying 7 times 80, £560 of the tax. But the firm isn't right happy either, because from their point of view, what's happened is that they're getting £3 per unit less. They're only getting 17, when they used to get 20. So therefore, we can see that from the producer's point of view, they're paying £3 times 80 is 240 quid, and the total tax is 10 times 80, which is £800. But obviously the impact is going to depend on the relative elasticity. So if demand's very inelastic, then demand won't fall by very much and price will increase by a lot. If demand is elastic, demand will fall by much more, and the government will end up with much lower amounts of tax. And you might want to practice drawing that. In terms of how effective is this likely to be, you can see essentially, so we're thinking about our indirect tax as a solution. In some ways, they're quite a good solution, because A, they do what's called, they internalise the externality. What that means is we make the polluter pay. So what should happen is that, if we get the tax right, output falls to the socially optimum level. And therefore the market failure has been corrected. Secondly, it raises revenue for the government. And then the government can use that either, in this instance, it could reinforce, the behaviour. It could create additional incentives. It could provide subsidies for alternatives, and so on and so forth. Or it could just use the money to reduce the budget deficit, or it could use it to provide merit goods or something. But those are the key points. That we try and set the tax equal to the negative externality, and at the same time it raises revenue for the government. And those are key points. In terms of why it might not work, when we evaluate, we can say on the one hand, it might be ineffective. Yeah, so you might want to think about PED there. You might want to think about firms' profitability. They might simply absorb the tax and continue to behave as they want. Yeah, you've got to get the size of the tax right and so on. Yeah, especially since it's hard to calculate the external cost. Yeah, it's a very subject. How much is a tree worth? It's very difficult to evaluate that. On the other hand, you might say that they have undesirable side effects. Yeah, that might mean that you don't like indirect taxes, because we know that indirect taxes, they tend to be regressive. Low-income groups spend a far higher percentage of their income, and therefore the impact of indirect taxes is it hits those sorts of groups disproportionately. You might also say that that actually all it's going to do is it's going to cause firms to relocate. So if one country is acting alone, all it's going to do is to drive companies to low-cost economies elsewhere. Maybe it isn't going to solve the problem. It depends on which problem it is that you're talking about. So that's your broad solution. In terms of other solutions, obviously, if you want to, if we just kind of list these, they're less technical. If you want to encourage the consumption or production of the good, you could use a subsidy, which works the same way as a tax, but in reverse. We could legislate. So we could pass laws, in other words, that restrict behaviour, or we could seek to inform. So if we believe that there's a degree of information asymmetry, then we could engage in public information campaigns to try to persuade people to change their behaviour. So if I was answering a solutions type question, I'd want to look at one financial solution, like a tax or a subsidy or a tradable pollution permit, something like that. One regulatory solution where we pass a law, and one information-based solution. That'll do for now.